Hello, this is Joe Cordell. Welcome to another episode of Cache Counsel. We've been talking about ways in which you can transfer assets during your lifetime for the purpose of minimizing estate taxes, and at the same time minimizing gift taxes, and we know also you have to keep your eye on income taxes. One issue that hovers over this discussion, particularly around the time in which we're changing presidential administrations, is that we don't know exactly where the taxes on estates and gifts are going. We know that there's been discussion about leaving in place what's in place now, which was engrafted into the code in 2001 that has a sunset provision. The sunset provision, this 10-year out provision, says that in 2010 you have taxes that essentially disappear on estates, and then in 2011 they return to their very low ceilings, the $1 million ceiling that existed in 2001. Since then, that has ratcheted upward on a periodic schedule that has resulted in a maximum of $2.5 million just in this year, and I think next year as well. So there's a lot of uncertainty. We could end up with estate and gift taxes disappearing entirely, but it won't happen by the inaction of Congress. Inaction results in the automatic restoration of the rates that were in effect 2001. Does that make sense? So we don't know, are they going to disappear entirely? If Congress was in that sort of mood and had that sort of legislative will, then of course it could happen. We've talked about the fact that while estate and gift taxes do not generate a large percentage of the income, as a matter of fact it's approximately 1% of all the tax revenues of the federal government, yet it has a lot of symbolic value, and it's a tax that has been around for the better part of this past century and has had a certain vitality to it, though it doesn't produce a lot of income or a lot of tax revenue. So I don't know which way the winds are going to blow. I suspect that the taxes are going to stay in effect at some level. We just don't know what level. So it becomes a question of, do you need to plan now to make these transfers in anticipation of rates that will be significantly higher down the road? That's the question. And really no estate planner, no asset protection planner is going to be able to give you a lot of clarity on those probabilities at this stage. So I think that maybe the safest strategy then is to move assets at a time when you know you can minimize taxes, when you know that you can do that either tax-free or with very little tax, with the expectation that taxes will increase in the future. I think that's a fairly good bet over time. We have seen periods, as a matter of fact we're at the tail end of a period perhaps now where taxes have been reduced. We were at a maximum marginal rate in excess of 70% here in the United States for a period of years. England in excess of 90%. So we've had a history where taxes have gone up very high. Now typically when we've had taxes that high, those were not estate and gift, that was in the form of income tax. But generally, in conjunction with that were a series of loopholes. Loopholes means just deductions and credits and other opportunities to avoid the tax. And we've shifted to a system now as far as income tax and estate and gift tax where it's pretty difficult to escape these percentages. So the percentages are lower than they have been historically, but yet there are fewer opportunities to avoid them, fewer available deductions and exemptions and credits that you might otherwise have had. So you can keep all that in mind as we have this discussion and recognize that the general rule of thumb is probably best to minimize your taxes today with the expectation that it would be better to do it today than later. I wanted to pick up with what we were talking about in our last show, and those of you who didn't watch that, you know that we covered issues relating to ways in which you can sell assets or you can obtain some sort of consideration. Now that's the legal term. This is in contrast to gifting. The whole idea now, remember, is to reduce what you have now, which is called estate depletion, with the expectation that you'll minimize taxes at your death. We know that if you gift certain things that you run the risk of incurring a gift tax. There are a number of exceptions to that. We've talked about that on previous shows. We know that you can also do a transfer for some sort of consideration. There are a variety of ways you can do that. You can do it in the form of an annuity. An annuity we've talked about is an exchange in which you receive something for the balance of your life. Now there are commercial annuities and there are private annuities, but their similarity is that the term of payment is geared toward the life expectancy of the seller. That's you. You can also do an installment sale, which resembles in many ways what you think of as an installment sale. Those of you who are involved in businesses It's where you receive a payment beyond the year in which you do the sale. If you have a payment that goes beyond the year in which you make the sale, then it's potentially going to qualify for an installment sale under Section 453 for those of you who have an interest in such things. And then you can do what's called a self-canceling installment note. The self-canceling installment note is a really neat device. It's a means in which you do an installment sale, but it provides that upon your death, the obligation is canceled. Well, there has to be some compensating consideration before the IRS is going to permit that. So you can increase the rate, you can increase the sales price, but there has to be some commercial viability for that to work. Now, when you're considering these options that are available, you have to keep in mind, what are the implications from a tax standpoint. We know that you want to avoid estate taxes. Well, if you do this correctly, you wouldn't have any estate taxes. We know you want to avoid gift taxes. Well, if you do this correctly, you'll avoid gift taxes. Why? Because there's no portion of the transfer that's donative. By that I mean there's no portion for which you're not getting consideration. Now, if the arithmetic were to turn out that the present value of the annuity that is being obtained by the seller, that present value is less than the fair market value of the asset that the seller, which is you, transfers, then of course that means that the balance is going to be a gift. It's not at all unusual to see these sort of split interest or these split transfers where they're part gift and part sale, and it can even happen unintentionally. In other words, if you decide to get aggressive in terms of assuring that you get back comparatively little from your annuity or little from your sale, if you play with those numbers too much, then the IRS may come in later, do an audit, and determine that in fact the present value of this stream of cash flows. I don't want to get technical. Some of you are saying, yeah, I get it, go on. And others of you are saying, what's the present value? Present value is just the stream of payments brought back to a number that it would have the equivalent value today. In other words, there's some number that if I gave you today, if you were rational, you'd be indifferent whether I gave you that lump sum or a stream of 10, 20, 1,000 payments in the future. There's a formula by which you can determine what that is. So if the IRS came in and used their numbers, which they have rates that are printed in the code, if they use their numbers and find that based on life expectancy and the discount rate, that what you have here in fact is an annuity that has less value than the value of what was transferred, then guess what? The difference is going to be a gift. So you have to decide, do you want to do that? Now, let me hurry to add, some people deliberately structure it in that fashion, and there are reasons to do that. But I'm going to assume for purposes of this discussion that your intention is to transfer this asset in which there are no gift tax implications. Now remember, if you fall short of $1 million, you have a lifetime exemption of $1 million. You also have your annual exclusions, which are $12,000 per person per donee. And then if you're a husband-wife, of course, you can do a split donation, which results in $24,000 per donee per year. So you can utilize those in conjunction with the transfer so that you avoid gift taxes, and yet you do get a value that's less than the value that is transferred. But if you're doing this as a 100% sale, then you want to be sure that the annuity value, that the installment value, that the self-canceling installment note value are going to correspond with the asset that's transferred. Also keep this in mind. To the extent that you're transferring less than 100% of the asset, we talked a little bit about this before, but you get a discount. That discount relates to marketability, it relates to minority interest, these factors that do in fact reduce the value. So commonly people will transfer part of a business, and they'll, if they transfer a closely held interest, a minority interest in terms of the shares of stock, the family limited partnership, then it is reasonable to take a discount, and we won't get into how steep that discount can be, but that should be in consultation with an expert, with the lawyer that you're using in your estate planning. But you can have that discount, so you do in fact get a substantial reduction beyond what the shares would otherwise have been worth in calculating the annuity that you get back. So you may be saying, well, wait, why wouldn't I want to get back the maximum amount that I could in this transfer? Well, remember, your motivation we're assuming here is that you're minimizing the assets that are going to be in your estate. And the problem with sales is that you're substituting one asset for another. So you want to be sure that there's been a net depletion in this transaction. Now, often with an annuity or an installment sale or any of these types of transfers that we're mentioning here,